Hi folks, in this question we have to calculate the diluted earnings per share, and you recall that when we refer to a diluted earnings per share we're looking to see if with all the convertible securities we have, whether they be convertible bonds, preferred shares, or even options, we want to see which of any of those might create an EPS which is less than basic EPS if those securities were converted at the earliest opportunity during the year. So with that in mind, we're looking to calculate a diluted EPS, which in fact should be less than the basic EPS. So let's begin. In our question, they give us an analysis of the corporate structure of the company, and you'll notice that they have not given us a basic earnings per share amount. So in order for us to determine if any of the convertible securities, specifically the preferred shares and the bonds, are dilutive, as well as the options are dilutive, we need to know what the basic EPS is. So that's our first step, find our basic EPS. So we know that basic EPS is going to be equal to what? Earnings available to common divided by your total weighted average common shares outstanding for the year. So in our case, our earnings available to common would be what? We can calculate that as net income less any preferred share dividends that have been declared or could have been declared, particularly if they're cumulative. So now, in our case, if we look at the data in our question, it tells us that our net earnings or net income for the year was $1.5 million. And if you can't see that number, you'll notice that it's in the second line of your question. It's 1.5 million. Now we would deduct from that to find the numerator in our basic EPS any preferred share dividends owing to preferred shareholders. Now we would only be looking for preferred share dividends that we would calculate for the current year. So by definition it doesn't include arrearages if the preferred shares are cumulative. Now if you look at our question, we know that our preferred shares are cumulative and we have 15,000 of them outstanding. All right. So now there were no conversions during the year, so we had 15,000 cumulative preferred shares outstanding all year long. We know the dividend entitlement here is $20 a share. So in essence, we would owe them 15,000 preferred shares times $20 a share, okay, and that would be 300,000. So 1.5 million less 300,000 is going to give us a numerator in our basic EPS calculation of 1.2 million. Now we have to calculate or figure out what our WACC would be in our denominator for our basic EPS calculation. So don't forget, this is equal to net income less your preferred share dividend, okay, and that would be divided by your weighted average common shares. So now we're trying to find the weighted average common shares, and they just give you the number. They tell you in the question that it's 100,000. That's in the first line. So we know now that our basic EPS is $12 a share. So we're going to use that figure, and we're going to look at all of our convertible securities. We have options, preferred shares, and bonds in this question, and we're going to determine if they're dilutive. So, and with respect to the bonds and the preferred shares, we're going to calculate the EPS impact in step 2 in our dilution test. And if the EPS impact on the bonds and or the preferred shares is less than $12 a share, we're going to include them in the cascade in order to calculate our diluted EPS. So let's begin with our second step, which is the test for dilution. Let's start with the preferred shares. We know we had 15,000 preferred shares outstanding all period long. Now, those 15,000 shares were paying a dividend of $20 a year. What if those preferred shares had been converted at the earliest opportunity during the current year? They were outstanding from the beginning to the end. Here they are at the end of the year, 15,000. What if we had converted them earlier in the year, the earliest date they were available to be converted, which in our current year is the beginning of the year, January? What if we had converted them 12 months earlier? That's how we'll calculate our EPS impact. So if the investors had converted those preferred shares, and it said here that each preferred share can be converted to 4 common, if they had been converted how much of a preferred share dividend would have been avoided, because that would increase the amount of earnings available to common, right? Because your preferred share dividend wouldn't be deducted. So if you're not going to deduct this, that means you've got more income available for distribution to your common shareholders. If we avoided that preferred share dividend, again, if they had converted the preferred to common, and we're going to divide it by the number of common shares that would have been issued if they had been converted. Well, we already know from our calculation up here that we had to deduct the preferred share dividend entitlement for the current year of $300,000. So we could have avoided doing that, right? And we're going to divide that by what? We're going to divide that number by the number of common shares that would have been issued if we had converted, which is 75,000. Don't forget, each preferred share, okay, each preferred share gets 5 common according to this question. It says each share is entitled to an annual dividend of $20 a share and is convertible into 5 shares of common. Okay, so now we would have had an extra 75,000 shares out there, and that would give us an EPS impact of $4 per common share. Since that $4 is less than our basic EPS, then it's dilutive, and we're going to include it in the diluted EPS calculation. Now we're going to have a look at the 6% convertible bonds. Now, if we look at the convertible bonds, what we see is that in our case, it says there were 500,000 of them, and 100,000 of them had been issued on May the 1st during the year. So it says the debentures or the bonds are convertible into 12 shares for every $1,000 worth of bonds. So the bonds are sold in denominations of 1,000, and you have 500 $1,000 bonds. But 100 bonds, which represents $100,000, of those 500,000 didn't get issued until later in the year, May the 1st. So what we want to calculate here is we want to calculate the individual EPS impact. So what would our impact on EPS be if we had converted those bonds into common shares? Well, the first thing is, in the numerator, what would have happened? Well, we would have avoided on 400 of the $500,000 in bonds, because those 400,000 in bonds were outstanding from the beginning to the end of the year. So again, you have to think of the 500,000 in bonds. Let me just do it here. Of the 500,000 in bonds, we can separate that up into 400,000, which were outstanding from January 1 to December 31st, plus the other 100,000. With the other 100,000, which were issued on May the 1st. So what we want to find out is, for these $400,000 in bonds, if we had converted them at the earliest opportunity, which would have been January 1st, because they were outstanding all year, how much interest expense would we have avoided on an after-tax basis? For these 100,000 of the 500,000 that were issued on May the 1st, how much interest expense could we have avoided booking on those had they been converted at the earliest opportunity? Now, the $100,000 in bonds is interesting. Why? Because they were issued on May the 1st. So the earliest you could have converted these bonds in the current year would have been May the 1st. You couldn't have converted them January 1st because they weren't issued till May the 1st. So that's going to make a difference in your calculation in the numerator and the denominator. So let's focus on the numerator first. We know we would have saved 6% coupon, which is your interest expense in this question, because there's no premium or discount here. They'd have told us if there was. So we would have saved $24,000 in interest expense on the $400,000 in bonds. And on the $100,000 in bonds, we would have saved what? $6,000 in interest expense. But don't forget, this 6% is what? It's an annual rate. So we would have saved 6%, but only for 8 months of 12. If we had converted them on May the 1st, which would have been the earliest time we could have converted them, because that's the date they were issued. So we could have saved $6,000 in interest expense over the period from May the 1st to December 31st, which is 8 of 12 months. So if you factor this down to a number, that's going to be 4,000, the number I've got highlighted here. This is going to be 24,000. So 24,000 plus 4,000 is 28,000. On an after-tax basis, 1 minus your tax rate is going to give you 21,000. So that's going to be your change in the numerator. And we no longer need this little bit I got here. So now, in the denominator, what would have happened? Well, if those bonds had been converted at the earliest opportunity, how many more common shares would be out there? Well, we know for every $1,000 in bonds of the 400,000 that have been outstanding all year, we could have converted them into 12 common shares right in January 1st. But these $100,000 in bonds, each $1,000 bond or 100 bonds could have been converted to 12 common shares. But we have to wait it because the earliest we could have converted those bonds to shares would have been May 1st. So those shares could have only been outstanding at the most for 8 months of 12. So we waited here. And that together is going to give us what? This is going to give us 4,800 shares here. And if we do this calculation, 1,200 times 8 over 12 is going to give us 800 shares. So if we add 4,800 shares that could have been outstanding earlier in the year, and these 800 shares here that could have been outstanding earlier in the year, we'd have in total an additional 5,600 shares on a weighted basis outstanding. So if we want to look at the EPS impact on the 6% convertible bonds, our EPS impact is going to be 21,000, which we get from here, divided by 5,600, the change in the denominator. And that's going to be an EPS impact of $3.75 per common share, and that is definitely less than $12 a share, so therefore it is dilutive. The last thing we're going to do here is we're going to look at the options. Now the options are easy because you can see here that the option exercise price is $35 a share. But the average market price for the year is 27. So because the exercise price exceeds the market price, a person in their sane mind would not pay more to exercise the shares than the market would give them for the shares. Therefore, the options are said to be anti-dilutive. So we are not going to include them in our cascade to calculate our diluted EPS. So that concludes our step 2 analysis here. Okay, in calculating which securities are going into the calculation of diluted EPS. The only thing we have to think about now is with the 6% bonds and the preferred shares, which are going to go first in the cascade worksheet to calculate the diluted EPS. The ones that go first are the ones with the smallest EPS impact. Here you see 375, which is the EPS impact on the 6% bonds, is less than the EPS impact on the preferred shares. So because of that, the 6% convertible bonds will go first in the diluted EPS calculation. So now in step 3, in order to calculate our diluted EPS, we're going to compare what? Our earnings available to common shareholders, right, in the first column, and this would be our WACC column, and this would be our EPS column. So the extra earnings that would be available to, the earnings available to common under the basic EPS, we calculated this in step 1. We had it up here, and we calculated 1.2 million in the numerator, and we were given 100,000 in the denominator, so we knew our basic EPS was $12 a share. The reason we put that as our first line in the Cascade worksheet is because we want to see how low our EPS can go. If we're starting to get an EPS that exceeds $12 or begins to go up in the Cascade, then we can't use it in the Cascade worksheet. It's not giving us the most dilutive position. So we always got to know our starting point upon which we compare all future EPS calculations as we add convertible securities to step 3 in the cascade. So we said the bonds were going, bonds were going first because the EPS impact is less for the bonds than it is for the preferred shares. So we know that the bonds, if we had converted them at the earliest opportunity, it would have increased our numerator or earnings available to common by 21,000. That's the number you have here. And it would have increased our WACs
of 5,600. So in order to check to see if this security is dilutive in the cascade, we're going to do a subtotal, and we'd see we'd have 1.221 million in extra in earnings available to common cumulatively, and 105,600 weighted average common shares. If we divide the 1.221 million by the 105,600, we're going to get 11.56 per common share, which is less than $12 basic EPS. So it's getting lower, so that's a good sign for us. Now, the last thing we want to include are our convertible preferred shares. And we said that the convertible preferred shares, if they had been converted, we would have had $300,000 extra available to our common shareholders because we wouldn't have declared a dividend to the preferred shareholders, so the common could have got that. And we would have also, if the preferred shareholders had converted their 15,000 shares to common at the earliest opportunity, had an extra 5 common for each preferred, or an extra 75,000 out there. So in our diluted EPS will be calculated based on the total of this subtotal and the extra 300,000 in dividend that would have been available if the preferred shareholders converted to common. So that would have been 1.521 million in earnings available to common, and 180,600 as our WACs. And if we divide the 1.521 million by the 180,600, we'd get a diluted EPS of $8.42. So now in your income statement, you would show a basic EPS equal to $12 a share, and you'd show a diluted EPS equal to $8.42 per common share. And that concludes our video on calculating diluted EPS when we have convertible securities.